The Big Short is a 2015 Oscar-winning movie that is based on the best-selling book of the same name by author Michael Lewis. The life stories of various American financial experts who anticipated and benefited from the burst of the housing bubble are the main subjects of the film, directed by Adam McKay. So, in this video, we're going to explain the film, The Big Short, and correspondingly, we'll try to figure out how Michael Burry predicted the 2008 housing bubble. In the film, hedge fund manager Michael Burry, played by Christian Bale, develops the suspicion that the US housing market is an asset bubble. To short the housing market, he develops a brand new kind of financial instrument called a credit default swap. He puts a suspension on withdrawals from the fund in response to his customers' demand for their money back, further infuriating them. He creates a fortune for investors who stick with him through the whole collapse when it eventually happens. Later, he makes an unsuccessful attempt to sue the rating agencies for misrepresenting mortgages and mortgage-backed securities. And that's what the film shows. But how did Mr. Burry figure it out at that early stage? We'll dive deeper into that query soon. But before that, let's take a quick look at the 2008 mortgage crisis for a better understanding. The financial collapse of 2007 to 2008 robbed many regular people of their jobs, money, houses, or in some instances, all three, resulting in a financial and economic catastrophe. Since the Great Depression, no catastrophe has been as terrible as the current global financial crisis. Dr. Michael Burry profited greatly from the collapse of the global mortgage market in 2008, while billions of dollars went to waste. The housing bubble will explode in 2007, according to Dr. Michael Burry, who launched the hedge fund Scion Capital in 2000. Before the financial crisis in 2003 and 2004, Dr. Burry examined mortgage lending processes. He decided to short the market and convince major financial companies to sell him CDSs on hazardous subprime loans. How did Michael Burry foresee the housing bubble of 2008? In 2003, he recognized the first warning sign when he realized how quickly mortgages were being made available to subprime customers. Subprime borrowers are those who provide a greater risk to the stakeholders involved in the loan process. They have the worst credit ratings. Loans that are provided to them are thus seen as dangerous. Resuming our conversation, dangerous loans that were provided were subsequently bundled. They were then released to the market as securities backed by mortgages. MBSs, or mortgage-backed securities, are bonds backed by mortgages and other real estate loans. Dr. Burry chose to wager after seeing an opportunity. By 2005, he had become sure that this collapse would occur, so he created a financial derivative product called a credit default swap and used it to short the housing market. This derivative financial product is used as a weapon against the housing market. It functioned as an insurance product, and Dr. Burry was required to pay a premium to protect himself from payment if the housing market began to decline. At first, the premiums he was paying were affecting the profits his business was making. He therefore experienced investor backlash as some investors asked their funds to be removed out of concern about his projections. The issue began to develop as Dr. Burry had foreseen later in 2007. He made $100 million from his wager against the housing market, while his investors made $700 million. Credit rating agencies, in his opinion, were acting complacently, and he predicted that this would pay them dearly. Although they were referred to as subprime structures, rating agencies assigned the safest 80% of assets a AAA rating, while classifying the riskiest 20% as BBB, or investment grade. According to Dr. Michael Burry, 20% of securities had interest-only mortgages connected, while 50 to 70% had cash-out refinancing attached, and homeowners were exchanging their mortgages for even larger ones. Finally, between 30 and 40% of the borrowers engaged had FICO credit ratings below 600. According to Dr. Michael Burry, 15% to 25% of mortgages had LTVs of above 90%. He continued by stating that 40% of loans had second liens. This implies that if the borrower files for bankruptcy, another debt will be paid off first. Spreads on securities rated BBB were 150 basis points, down from 300 in the previous year. This indicates that investors did not consider these items to be dangerous. Dr. Michael Burry won by making contrarian wagers on multiple occasions. When the S&P 500 fell by 11.88% in 2001, his hedge firm, Scion Capital, grew by 55%. These incredible gains were made possible by making contrarian bets. When the internet bubble was at its height, he shorted expensive tech companies. His hedge fund increased by 16% the next year, while the S&P 500 plummeted by 22.1%. The S&P 500 increased by 28.69% in 2003, a spectacular year for the stock market. Scion Capital, the hedge fund run by Dr. Michael Burry, had again outperformed the market by generating gains of around 50%. Recently, Dr. Michael Burry has been in the news for his prediction that the stock market would soon reach historically low levels. And that concludes our video today. Drop your thoughts in the comments.